Hello, and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school seller-led approach is dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. And let's be real, it's not just about closing the deal, it's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kisan Patel, founder and CEO of Deal Room and chief scientist at M&A Science. Joining me today is Byron Lichtenstein, managing director at Insight Partners, a leading global software investor. Byron helped shape M&A strategy across Insight's 500 plus portfolio companies, bringing a rare blend of operational insight, venture speed, and private equity rigor. In this episode, we're going to dig into how Insight executes buyer-led M&A at scale, supporting CEOs from sourcing through diligence, integration, and everything in between. Byron, how you doing?
I'm good. I appreciate you making the time. I'm excited to be on the podcast. I was listening to a few this morning over the last few weeks, and I love what you're bringing here. I love the buyer-led M&A angle. Could not agree more with you that you need a good strategy and some good execution to get it done.
Well, thank you for taking time from doing deals to have this conversation here. We're Insight Partners headquarters in New York City.
It's good, right? We, pretty good view. I appreciate you coming in.
Oh, absolutely. Thanks for making it happen. Can we kick things off a little bit about your background?
For sure. So, Byron Lichtenstein, I'm a partner here at Insight. Been here just over 10 years. I run our diligence and growth strategy team. You can think of that essentially as in two parts. One is helping our team kind of run as fast as it can, but make sure that we are as excellent as possible on the diligence and underwriting side. And then ultimately, when we get a deal done, really thinking through what is the growth strategy for that business and how do we manage their portfolio. As you mentioned in the intro, we have over 500 portfolio companies. And so we have a lot of resources internally. And our job is make sure that all those companies are successful and that we're putting the right resourcing against the right company at the right time. And so a lot of my job and my team's job is figuring out what are the strategies for those businesses, working obviously with our founders and our management teams, but then figuring out where can we deploy all of our heft and our scale to actually making them grow even faster, making them even more profitable. And so I know we'll talk a bit about that today, but I think we've built a pretty cool team here and excited to go into it.
You've been at Insight for a while.
Yes, it's been a journey. When I joined, the firm was about 70 people back in 2015. Now we'll be just over 400. My team specifically was about 6 people. I think now we'll be about 50. And we've built a lot of components. As I look at the structure of the team today, especially on the value add side, so our Insight On-Site team is our value add team, and that group is 120 people today, which is amazing. I mean, that it came from the 6 of us originally to 120 today, of which I have about 50. But you also look on the other side of the team, and there's former CROs, former CTOs, former CMOs, heads of talent. And our job is, as Insight On-Site, to bring all of Insight's heft, all of the data, all the experience, all of the access to our portfolio. So it's been a wild ride. I mean, we were on our 9th fund, about $4.5 billion. We're on our 13th fund, about $12 billion today across multiple strategies. And so I've really enjoyed the ride, been extremely grateful and fortunate.
I was going to get at that. I mean, the firm, I think totally owns like 100, right?
Close to it. I think we're about 80 today.
Okay. We'll round up
to 100. And we do everything Series A through take private. I think for us, the biggest thing is being flexible and really understanding software.
Well, the point I was trying to make is like you're not cutting small checks. And I think there's an interesting variation because even at 12 billion size, you're sort of making quite a few bets out of that size of a fund.
Totally. I mean, our strategy, you can reverse the clock back to 2015, 2016, and as the fund started to scale, most funds, and where our LPs get worried that we would go, is most funds, they start to change strategy. They say, we're going to do bigger deals. We're going to go later stage. And for us, like, we've always done buyouts. We've always done Series A. And Jeff Horing, our founder, got up in front of all of our LPs at our annual meeting and said, we're going to do the same companies. We're just going to do more of them. And we're going to double down into the ones that really, really work. And so for us, we want to play at all those stages. We believe that having a comprehensive view of the entire software market is meaningful. And overall, what it enables us to do is every market, whether it's M&A software or legal tech or healthcare IT, like, there are going to be winners, and sometimes those winners are going to be later stage, and that's where we want to play. And sometimes those winners are going to be the next generation of AI-driven businesses today within different verticals, and sometimes we want to play that end of the market. And so we try and take this really fundamental approach of saying, look at the market, what are the dynamics, and what is the right stage of company to play this market? Because when what we care about is 5-10 years from now, who's going to be the biggest leading business in that category? And sometimes that's going to still be the incumbents, and other times that's going to be the business that got created last year. So we want to be able to see all of that and play the market right.
Playing smart as a strategy.
Trying to. I think playing smart, but also being flexible. I think if you are a fund who has a very, very tight mandate around, this is the exact vertical, and I'm only going to do companies, and I'm being exaggerating, I'm only going to do companies between 20 and 30 million of revenue, that box gets really, really tight.
Exactly. Well, I've seen it. I've seen you guys do a lot of interesting things, these crazy carve-out deals, and I'm sure we'll get into some of that. Yeah. What is something, if you look at early in your career to now, there's like your views completely flipped around in M&A?
In M&A specifically, I started in 2015, and I would say at that time in the market, it was early stages of this idea of call software roll-ups, right?
Yep.
And I think that there were a few early wins of folks who essentially said, all right, there's a dislocation in the market. The PE guys won't buy anything that's under 50 million of revenue, but there's all these businesses out there that are 5-10 million of revenue growing 30%. So if I take 5 $10 million companies that are growing 30% and I smush them together through M&A, I now have a $50 million company growing 30%. And I think there were some early rewards there. I think if you fast forward to where we are today, I think the buyers have become much more sophisticated, both PE and strategic. And I think the customers have also become more sophisticated, right? They are looking for really strong product, and they are willing to switch for really strong product. And so I think ultimately, like, we still deploy M&A as a strategy meaningfully, but I think that we've become more nuanced in the way that we approach it. We want really strong anchor products, and then yes, you can add on through M&A and do smaller roll-ups. You can do consolidation. You can do market expansion. You can do new products. But ultimately, I think where we're seeing software companies get rewarded is by maintaining product edge, not just having all the boxes ticked across whatever, product architecture you want to create. And I think that's been the biggest change in the market that I've seen. And I think you still want to be on the aggressive side of thoughtful, but I think you want to be as thoughtful as you can be with M&A.
Strategy matters.
Strategy matters a ton. It matters a ton where, and I think you have to set that early, and you have to actually have a vision. And there are some examples. I think about one, and we partner with a lot of other firms. We partner with a lot of other PE firms and venture firms, and we're always trying to learn. I think if I look at Insight, we have our core values, and one of the core values is commitment to reinvention. It's we're always trying to ingest as much information from other sponsors, and we work with a few others on some of our larger buyout platforms. And I would say there are others who are a little bit more aggressive, and there have been some really amazing get luckies where, oh, this product kind of fits and it actually took off really well. So like it's not to say that it doesn't work, but I do think if you can do the mapping of where you want to be in 5 years and that includes where you want to be on the product, and you can be pretty strict around that, you should be aggressive about pursuing that roadmap and like try and stay laser focused on it. And you set that strategy early and you go for it.
What is that? And what do you end up doing when you do that? Do you end up, hey, we're really going to focus on bridging product feature gaps, and we're really going to focus on just serving this core customer base and trying to buy companies that have that same customer base, versus the next shiny thing or this? It's away from the core, but we'll make it work.
I think it just creates a lot of, the goal is to create a team that knows what you're aiming at, a management team and an investor group that knows exactly what you're aiming at. I take a business like NMI, so payments infrastructure business. We invested, we bought a stake from Francisco Partners about 4 years ago at this point. Amazing business. You're talking 250 billion of payments volume going through that platform every year. But when we bought it, it was most of the revenue was on its core gateway product. And our thesis was from the get-go, and we're very aligned with Francisco on it, was we have about 1 million customers. We have that 250 billion moving through the platform, and it's just going through this one product, this one gateway product. And we need to be able to expand the product suite that we're selling into our customers. So our core customers are ISOs, so independent sales organizations, and that's people who sell payments to other merchants. And we said, we want to be the arms dealer to them. Today we sell them a gateway. There's so much else we could go sell them. And we had this core product vision of here are the products that we're going to add on to that business. And within 6 months, we started to add. But as you can imagine, to the focus point, there are so many payments businesses out there. And if we wanted to just do 30, 40, 50 deals, we could probably go do 30, 40, 50 deals with this as the main anchor. And Kate Hampton, who's the head of strategy and corp dev over at NMI, she's kept everybody super disciplined of we still look at the deal flow. And we'll talk a little bit about, the sourcing engine for our insight, but we still send her a lot of deal flow, but she probably ignores or says no to 98% of the things we send her.
The Buyer-Led M&A Summit is back October 30th, hosting over 1,000 corporate development, private equity, everybody on the buy side. You'll hear from the best in M&A from companies like Quadient, SBS Commerce, iSolve, State Street. These are all leaders who have built repeatable, scalable M&A strategies. You're going to learn how to prioritize deals, execute diligence under pressure, bring integration all the way to the front of your deal process so you can realize synergies faster. Did I mention we're going to do a live M&A Science podcast with Keith Crawford, the head of corp dev at State Street Capital. Whether you're new to the industry or a serial acquirer, this is an event you don't want to miss. Hope to see you there. Bye. This episode is sponsored by Deal Room. And if you're on the buy side, you know the pain. Most M&A tools, especially those clunky data rooms, aren't built for you. They're made for sellers, and it shows. Deal Room is the #1 platform built specifically for buyer-led M&A. It's designed to help you lead the deal from pipeline to diligence to integration with the structure and visibility you actually need. You get features like built-in project management, templated deal rooms, real-time collaboration, and AI contract review, all built to support how buy-side teams really work. No jumping between tools, no messy workarounds, and no hidden fees. Check it out at dealroom.net or click the link in the description to see how it makes buy-side M&A a whole lot easier. Lead the deal, own the outcome, here's to the deal. Having this 5-year vision, but I think there's this element of the central distribution, which is what makes it more synergistic, where how do you sort of get more like wallet size from these customers? I think that's the key theme versus if you don't, and you're just saying, hey, we're just going to buy all these different things in our field, then you're not, that's the thing you don't want to avoid, basically.
Correct. I think people think of M&A as this major category. In reality, you got to break it down to why are you doing M&A? And it comes, you can break it down into a couple different categories. There is one, just pure market share gain. I am going to, this market should be consolidated. We have a good product, we have a leading position, and we want to solidify that position. That's valid M&A. There is what I call product expansion. So, hey, we want to sell more products to the same customers. And I think where people go wrong on that one sometimes, just as an aside, is they go different product and different customer. Like right. You're like, oh, I kind of I kind of sell to GCs as well as CFOs. And so I'm going to add on this product instead, right? And in reality, I think you want to think about, if you're going to go the product adjacency route, you want ideally same customer that buys your current product will also buy your new product, right? It's the same buyer within that organization. And then you have geo expansion. You have kind of new channels that you can get into as other strategies. And I think just getting really crisp about what type of M&A you're doing, because each of those types of M&A also come with their own playbook, right? Of how do I implement it? What do I actually care about? How am I changing my diligence?
What if you're a product that wants to get to a different customer base? And I'm going to use our company example because why not?
Yeah.
For us, we have core customer corporate development. And I'd say one piece is we're doing all this cool AI with contract analysis.
Yeah.
But we don't actively sell to lawyers, law firms. I'm like, this is a big market. We got a great product that does this and a bunch more.
Totally.
Does it make sense for me to buy? And you're starting to see this big shift where a lot of these companies have, you got to keep up with all generative AI, or you're getting sort of like a legacy phasing out. So there are products like that where their growth has gone stagnant because they haven't kept up.
Totally.
Does it make sense? Is that still considered a good practice here? If I go buy a company like that with this anticipation of well, we could at least leverage their sales team and go, merge them in, and then now we can go start distributing to law firms.
I think it depends on where you are in your life cycle.
I can tell you see this go sideways. Come on.
Oh yeah, I've definitely seen it go. I mean, I'll use a more obvious example, and then we'll get back to M&A. So, oftentimes I'll work with companies who are, 65% of our portfolio is North American based, 25% is Western Europe. 10% is mostly 10% is mostly Israel, and then there's another 5% rest of the world. I pretty much always get the question when companies get to 25, 30, 40 million of revenue that they're mostly US based, and they're like, should we go to APAC? Should we go I got one customer who called me from Japan, maybe we should start a Japan office. And my push to them is always, all right, have we run out of space in the US? Are you telling me we've run out of space? Because the CAC of going all the way over to Japan and setting up a new office and figuring out that motion and being, 12 time zones away, is going and getting that dollar cheaper than going and getting your next dollar in the US? And the answer is usually almost no, always no, right? At some point you will hit a scale where you have to go do that. On the M&A side, to your exact question, using Dealroom as the example, I'd say it depends on where you are in your growth journey, right? So my sense is you're still growing, but still relatively early. I'd say keeping focus on more things you could sell to corp dev. You'll probably get one, you'll have a better CAC going after just that corp dev buyer. But two, I also think you'll get a better multiple eventually, if you raise or whenever you sell the business, of saying we own this customer. Having strategic positioning like is the most important thing. Having a strong strategic position where a customer relies on your software and lives in your software, like that is the ultimate thing that you're aiming at, and that's what makes software sticky. And so if you have heft within a buyer, within a segment, you'll likely grow better and you'll get paid more than having like, some tendrils into one customer over here, another customer over there, and like selling a little bit. I just find early, sometimes companies try and get, they lose focus early, right?
Yeah.
And they end up trying to launch too many products too early. And like, we're all people. We all have time constraints. Time is the hardest. You can't get it back. Like it's the toughest resource. And like, no matter how good of a multitasker you are, you can probably only concentrate on 2 to 3 big rocks at any given time. And really probably only 1 to 2 big rocks at any given time. And the more you stay focused, we've just seen it time and again, like the companies that get to IPO status, they get to amazing stories. Usually they have an amazing core product, and that core product has grown immensely. And then they've started to build out once they started to get to that scale. Versus if you split your focus too early, it ends up being a distraction.
Yeah, because this other customer profile is going to have a bunch of different needs, and you're going to end up focusing on all this product work as opposed to that one core.
Totally.
Okay.
I mean, you have to be flexible too, right? Like I think my sense is, and you tell me if this is wrong, my sense is your product is awesome. It's working really well. Corp dev buyers love it. And so there's more to go sell versus, I'm my brother's a founder, my wife's a founder. So like, I totally get the early stage journey. And sometimes you're grasping for straws in the dark and you're like, all right, well, like that customer is willing to pay me some money. So like, maybe we should go grasp after that. I think in the early stages, like you are really trying to find product market fit. And so you may do some customer work or go after some customers that weren't quite your original vision. And like you have to do that to survive, especially if you're going to bootstrap. But like if your product's working, I'd keep hammering on it.
I'm going to blame the investors on this. They give me pushback. They want to see a high TAM because 20 million getting there is not high enough. They want to see a roadway for you to get to 40, 50 million. And then it's like, okay, you got to find other segments to sell into because
yes.
Corp Dev, we have 200 happy customers. It'll taper off around 20, 25 million. So like, all right, we got to find either private equities, another vertical, investment banking, or the law firms.
Yeah.
That's why I blame the lawyers on it.
I blame us too.
I blame the investors.
I mean, it's I think I've been through. When I started my career here. So I originally engineer by background. First job in college was for Procter & Gamble, literally designing fabric softener in a lab. And then ended up after school going to Bain to be a management consultant, mostly working in our private equity group. So like I've been in and around the space, but like really I started my career as an investor in 2015. And so like the first part of my career was like all up and to the right? So I saw like the expansion of software as a market and but you also saw the seeding of just some of these bad behaviors, right? And bad incentives, honestly, a little bit on our part of like growth at all costs, burn at all costs. And, the thing that I felt really fortunate about here is, we've always been pretty fundamental investors. And I think what people get wrong sometimes is they look at burn and they say, oh, burn by itself is a bad thing now. Or back in the day, they were like, burn is fine. In reality, what really matters is your unit economics, right? Like for every dollar I put out, how many dollars am I getting back, right? And like, I remember I talked to the Wix founder years ago, Avishai, Jeff Horing, our founder, was like, oh, he's in town, you should go talk with him. Like just pick his brain on what the best metrics are. And he actually used not just CAC payback, but like cash CAC payback. He's like, how quickly can I get cash back? Because then I can go and reinvest it. I can go put it more into marketing. But he was so tight on for every dollar I put out, here's how many dollars I get back, how quickly, and how much does it multiply over time. And so for us, like our company should only be burning if their unit economics are good. And yeah, if it means I have to go spend $10 million today, but I know I'm going to get 50 million out of it over the next 2 years, you should go spend those dollars. But like, If you're like, oh, I'm paying you $1, I'm paying you 10 million today, I'm going to get 5 million from you next year, and maybe less than that the year after that, like you probably not make that trade-off. And so I think it's really easy for people to get caught up in just the pure P&L. Here's the growth rate, here's the burn. In reality, you got to really break it down to for every dollar I put out, what am I getting back? And I think that's where people took rules of thumb and they went a little bit crazy, to your point, and they were like, I need big TAMs. You're like, why do you need a big TAM? If you told me that actually I have a $100 million TAM, and to hit my projections over the next 5 years, I only need to add, 10 million a year. And I feel like all this TAM is going to come up for sale in a given year. I feel like I have the best product. I can win, 70% of it. Like, I actually think you may have enough room, right? People want to see the big $1 billion TAM number. In reality, you just have to think about, like, is there enough market that every year there's enough customers that are trying to make a buying decision? And can I go capture more than my fair share of those? And is that enough to meet my projections? And if that's the case, probably fine.
Makes sense.
But yeah, sorry for the metrics rant.
I wanted that. I wanted to be challenged on this stuff.
Yeah.
This was so you run the whole portfolio support sort of more side of it. Can we talk through like how Insight supports M&A execution, especially like a lot of these deals? I guess what's your split between majority ownership versus minority?
Yeah. So for us, we have about 40% of our portfolio on a dollar basis is control. So 40% in control, 60% in minority. On a count basis, it's about 15% of our companies are, on a number of companies basis, are control, and about 85% are minority. So the vast majority of our portfolio is minority deals.
You treat them different?
I mean, yes and no. But I would say this, like, part of it's just a mentality. Like we are first and foremost, like, we want to be the best partners to our companies, right? And that comes from the venture heritage. That comes from this idea of, like, we sell founders on our vision. We want to be good partners to those founders. Those founders don't have to listen to us on the minority side. And like what that's created is it created a culture, even on our buyout deals. I think you could ask any of the CEOs, that I work with, and they would say, yeah, like Byron probably pushes sometimes, but ultimately, like, he is a good partner. And like if you really think about what control means, I think a lot of people get in our industry take the sense of like, oh, I'm the majority investor. You have to listen to everything I say, but your only real lever is whether you're going to hire or fire the CEO. If you're not willing to do that, you kind of got to let your management company run the organization, right? Like we're investors. We don't run businesses like our management teams run their businesses. And so we take that perspective of like, we want the best teams in there. We want to be the best partners to those folks and support them. And yes, there will be some hard decisions every now and then in the control portfolio, but ultimately, we want to treat companies the same. And my favorite stat, and we talked about, and I'll talk about the our Insight Onsite team more broadly. But my favorite stat is, I mentioned we have 85% of our portfolio that is minority. They don't have to listen to us, right? But if you look at engagement with our portfolio team, our Insight Onsite team, that team of advisors and diligence folks and portfolio strategists, like my team, like, our Insight Onsite team touches somewhere between 65 and 80% of the portfolio every quarter. That means that 80% of the portfolio has come to a webinar that we've hosted, done a call with one of our operational experts, done a strategy meeting. Like, we touch the portfolio. And so, a lot of our LPs ask all the time, like, oh, only 15% are control, or do you only touch those? No, we touch the whole portfolio. And so we feel really confident that we've built the machine to be as useful to everybody, and that no matter what stage you come in at, we've seen the journey before. We have the data, we have the expertise, we have the access to help you, and we just want to be good partners along the way.
What does it look like when it comes to supporting M&A for these minority shared portcos?
Yeah, it depends. There are some portfolio companies where they're not interested in M&A. And we won't, by default set up an M&A team to go support them.
Right.
But if a portfolio CEO comes to us, or CFO, or a head of, usually the venture ones don't have a head of corp dev yet. But like if an exec comes and says, oh, there's this really interesting opportunity, or a sourcing team finds something that they think could be interesting, we will spin up the effort, and it tends to be on the board member plus, somebody from Inside Onsite, or on our deal team. We'll go have the one-off conversation. And so I think what you can do is separate out the portfolio by companies where we set up a more structured approach and repeatable approach to M&A. And then there are the one-off M&A situations. And that doesn't break down by control versus minority. It just, there are minority companies that will fall into we have a repeatable motion. And so the goal is figure out what is the appetite for M&A. What do we think? Like, do we think M&A can be a growth lever here, regardless of our ownership structure? And then we will work to set that up. And so, if you look at the repeatable model, what that typically entails is CEO, CFO, maybe head of corp dev, depending where they are in their journey. We'll meet with our team and essentially say, all right, I'm going to craft strategy, so help them think through like where do you want to go? But oftentimes that's CEO led. Then we create a sourcing strategy. Then we have execution, so like we can actually help them do the diligence, go through all the pieces of the operations. We'll partner with the management team to get that done, and then all the way through actually funding it. So we have a whole cap markets team, and like huge shout out to Kevin and Nate who run that team. They would actually think about like, how do I go fund this deal? Is it debt? Is it equity? Should we bring in co-investors? Do LPs want to get in on this? We will go kind of soup to nuts on M&A.
That's a lot of support for a portco, especially when you have a minority stake. Do you charge for that?
We don't. Everything's free.
So your department's not a profit center.
I think the amount of value that we've created is more than pays for itself. Every time we do the ROI analysis, it's like it's bonkers, right? It's like I think of it as take pricing. We got a couple people who do pricing for us. I think because I'm using that as an example because I think it's the simplest one. There's a company where I think our team met with them for maybe 25 hours over the span of a month to kind of restructure how this company was looking at pricing. They dropped $2 million down to the EBITDA line, like using the new strategy, right? So that's $2 million. You put whatever multiple you want to put on it, somewhere between 15 and 20, right? So you're talking about, $30 to $40 million of value for this person's 25 hours of work.
Yeah.
Right, like so the ROI on that is just a bit bonkers, and so like for us, the reason we don't charge for it, and so like Hillary Gosher, who runs the full team, so I have our diligence strategy group. We have Pablo, who runs our advisory teams. That's all the former C-level folks, and then you have Mike Hayes, who runs our like access team, and then Brian, who runs our talent team, just like sourcing good talent. But Hillary, she's like the OG. She founded Inside Onsite back in 2000, and like she's been the one that's grown it and seen it. Like her big push has always been we could go and charge portfolio companies. There's a lot of our peers who will charge for consulting fees and management fees and all of that, but ultimately it creates two issues. One is companies who don't pay are not going to get access to it, even though they actually really may need the help. And then two, if there is a company who has paid, but we don't think that there's actually much value to create, like we still have people show up. Like we'll still have them have to like go and like justify why they're paying, and so they'll go to the board meetings and it becomes this whole thing of like, oh, like because you guys are paying me for the service, I have to show up even if there's nothing for them to do. And so ultimately what we think it creates complete alignment between teams to not charge for it, because any company who needs the help can ask for the help. And then ultimately though, on our side, we get to go where we think the highest ROI is. And so just because a company asks, like we always want to be useful and we've created scalable platforms, but like there may be something where like I have told companies before, hey, that ask is, I know it's useful, but like, why don't I actually go help you find an external consultant to do that? Or I actually think you need to hire 2 more people on your team to go do that. That's not something we do. And so there's no justification of our existence because we only want to go after the meaningful problems where we think we can actually have ROI in these businesses. So like our incentives are 100% aligned to our portfolio companies.
How, because you do everything, right? Venture, buyout.
Yeah.
How do M&A strategies differ at these different stages? And where do you see the commonalities?
Yeah. So I think every company at every stage should be thinking about M&A as a potential lever. Yep. I think if you reverse back the clock to 2015, M&A was just this PE thing. All the venture guys, investors, companies that are like it's a distraction. We have the best products in sliced bread. We're going to take over the world. There's no need to do M&A, any of that. And I think what we've seen over the years is one, I think the market's come around to even for venture that they should be open to doing M&A. I think what ends up happening is, we talked a bit about the repeatable versus the one-off model. I would say on the venture side, it tends to be you're leaning more organic growth than inorganic. And so, we want to encourage our companies to be open to the one-off possibility. Like, is there a company that you could go buy that would be a total game changer for your strategic positioning in the market or expansion into this new vertical? And we try and identify that with the venture companies early. And then we say, all right, our sourcing engine, and I should probably speak a little bit about our structure at Insight. We have 70 folks who their job is go find software businesses. They are talking to, in the latest stats, something like 40,000 software businesses a year. And all we're doing is trying to, if it looks like software anywhere in the world, we want to talk to it and we want to know it. And so we've built this engine to just understand the software market. And so it's what we do is we'll work with a venture business. We'll identify what are the game-changing moves that they could make. And then the sourcing team will put it on their radar, and if they can crack one of those, great, and we'll send it in. On the buyout side, and for some of our larger minority positions, we will have a more dedicated strategy of we're going to talk about it, day one. What's the strategy you want to go after? How are we thinking about inorganic growth? We'll set up a regular cadence, whether it's monthly or every 2 months, of checking in with the business. We'll put a dedicated, it'll be dedicated to an analyst or an associate on our sourcing team of all right, certain percentage of your time is actually dedicated to this company to help them find deals. And then we do have dedicated portfolio support that can help them think through actually doing the execution, thinking through the implementation or integration plan, and actually getting the deal fully done.
What, how do you look at the deals that just pan out the best? We used the example earlier when we were talking on the side around buying the competitor.
Yeah.
There's that. Then there's, what was the term you used earlier? Marketecture.
Yeah.
You start figuring out all these other products that you can sell into your customers.
Yeah.
What works best? What do you see as the best bet? Especially the companies at that earlier stage too.
Yeah. I would say in terms of what works best, it is just going to depend on what you're going for strategically, right? I think about, we use this phrase, when we first make an investment, I want the CEO and executive management team to write the S1 on day one, right? Obviously not everybody in our portfolio is going to IPO, but the S1 is the marketing document that a pre-IPO business puts out into the market right before they go public, right? And it basically spells out, here's where we are today, and here's the vision, and here's why you should invest in this business. And what my hope is always for all of our businesses is the day we invest, we should be writing what we want that to be, right? It's the Amazon, write the press release before you do any initiative. It's the same idea. What's the public story you're going to tell in 5, 6, 7, 8 years, and how do we then align everything to that? And so when we think about actually going and doing M&A, it's going to look slightly different. There are going to be somewhere it's purely about product. We feel like we have the best. You take NMI, we feel like we have an amazing customer base, a ton of volume moving through. It's all channel. We have the channel. Now we just got to put product through that channel. Versus, take a company like Bullhorn. I know Art Pappas was on the podcast at some point, and he is he's an amazing CEO. He's one of the best CEOs I've ever had the pleasure of working with. And like, I say that because if you just look at his journey, you don't get that many CEOs who found a business, go through the venture, go through the whole venture growth stage, sell to PE. I think he's on his third PE sponsor at this point. And like he survived throughout, and like he's grown, and I think he wrote the first version of the product. Like he knows the product in depth, but he's great on sales. He's great on vision. He's great on execution and hiring and all those things. Like I won't stroke his ego too much, but I think he's great.
Check out the podcast. Yeah, but no, I totally agree.
You should definitely, but like, I think for him, if you look at that business, so we actually,
this is, just to clarify, this is like an actual exercise you do with your portcos. I think you referred to this in a past conversation as a strategic positioning as the North Star. Let's go, like walk me through it.
Just strategic positioning. So that strategic positioning piece is that S1 statement of like, where are we going to be? Who do we want to be? What are the core tenets of building an amazing business? And if you know that, if you know you have to expand your market, to your piece earlier, like when I'll take Bullhorn just because we were just talking about it, pretty much from day one, the strategic positioning we knew we wanted to achieve was the first core tenet is we need to be the clear market leader within our recruiting CRM business, and like all of the actual kind of back office pieces. Like we want to have 50, 60, 70% market share. Like that was one piece. And then the second component was we knew we needed to expand the market because we knew, it's a big market. It's probably $800 to $1 billion of TAM. And we thought we could really grow into that and make a giant business. But we also knew that wouldn't it be nice to have another $1 billion of TAM? And so, pretty early in that business, like we had those two kind of strategic positioning imperatives. And we said, all right, we're going to use M&A mostly for the first one. So how do we actually build market share? How do we really think about the positioning of adding new features and making sure that the customers are still happy and making sure that they're retained? And then on the organic side, on the expanding the TAM, we had one or two small product acquisitions, but we also invested meaningfully in the organic product. Like Art came, I think, at our first board meeting and said, I think I can unlock $500 million of TAM with like a $3 million product, like R&D investment. And so of course we greenlit it, right? And you fast forward to when we actually sold it. So we sold that business, 3.5 years after we initially invested for a pretty good return. And that was core to the story.
I would sub that out a damn good return.
Yeah, it was good. And what was fascinating is, we bought that business from another sponsor. And they, I'd say like operationally that business was humming. Like there's always this idea of like, oh, if you buy it from a sponsor, it's already been optimized, and like, can you actually get a return? Like I would say like we bought it and like that sponsor had it was in great shape. Art and his team were like operationally like amazing. And then I think what our unlock was as insight is taking a little bit of our venture heritage is like we're willing to swing for stuff, and like we're willing to go after the product expansion, go after some of this M&A in a slightly more aggressive fashion, and like we aggressively pursued it, and it was a good return. And so like I do think that building where we could have just done the same thing and it would have been a fine return, right. But like if you really want to go for the good return, getting the vision of where you need to be, and then like staying focused yet aggressive on those paths is the right call.
That's the shape which deals you should be doing.
Totally.
What does it mean, founder-led but not founder-limited?
For us, we want to be really good partners. As I said before, like we want to be amazing partners to all of our companies, and most of the, I said 85% of our portfolio is minority. A lot of those are founders. And there is something about founder energy that I think is amazing, and we want to harness that as much as possible. But there's also a lot of founders who, by the time we invest, it's the biggest business they've ever run in their life, right? Yeah. And I think there's something really meaningful to be said for supplementing that founder with other execs and making sure that that we're both harnessing the amazing talents of that founder, because getting it to whatever scale that we're investing in is no easy feat. And like, we want to keep that energy, but we also want to make sure that we're supplementing with folks who have seen the story before and can look around the curve. Not to say that they're going to know exactly where the destination is, but at least they know that, 9 times out of 10, like, if bookings is off, you should do X, right? And just seeing some of those processes at scale, it's like, why wouldn't you use that data? And so for us, when you think about kind of founder-led but not founder-limited, we want to help our founders grow, and we want to help our founders like build the best business. And ultimately, like, we are aligned. I think I think about my consulting days versus the now as on the investing side, like, we have zero incentive other than make your business bigger and worth more. Like, we only get paid when the business is worth more tomorrow than it was today. And a lot of our founders, like, they are meaningful shareholders, and our goal is make sure that their dollars are multiplied as well. And so it's really working with them to harness what they're really great at, supplement them on places where they could potentially grow or over those blind spots, and just be good partners to them.
What about the founders? Okay, I got some belief in your model here.
Yeah.
But now you've worked with hundreds of founders, CEOs.
Yeah.
What are the key qualities that you see are the ones that will scale well through M&A versus the ones that don't?
Yeah, no, it's a good question. I do think that founders who are like, the thing I love most about a lot of our founders is like, they love their businesses and they are obsessive, right? Like, I think you have to be. Like, I think you have to get into the details, and you have to really be willing to like dig deep. But at the same time, you also have to be flexible, right? I think where I've seen founders, maybe I'll take the opposite of your question, where I've seen founders go wrong is like a belief that their product's always the best, a belief that they are 100% always the right person to solve the issue at hand. And I think the most successful founders in our portfolio are the ones who are willing to ask for help, who are willing to acknowledge their blind spots, but also are super confident in where they are really good, right? And they are willing to dig in. And I think the partnership really works with us our biggest value add for a lot of our founders is bringing data and expertise and saying, ultimately, your business is going to be like, it's your baby, you know it well, but maybe I can bring a couple other data points of 10 other businesses that have kind of gone through the same problem with you. And those who are willing to listen tend to, or at least be open to the idea, tend to do quite well.
So just don't have a big ego.
Yeah, I mean, I'd say this. There is ego inherent in the job. Like, you have to be willing to like inherently pay more than other people or take a bet on something and believe that you are right over others, right? If you are purely doing what everybody else says, like, you're never going to make any money. And this job's like inherently, like, you have to have some ego as an investor. But ultimately, the thing that I love most about Insight, like, we can talk about it, and there's an aside of I don't know if I do this exact job anywhere else. Like, I do think this place is special. And the reason for that is, I talked about our core values earlier around, commit and reinvention, but our number one core value is hunger to win. We're super hungry to just like, we want to be in the best deals. We want to be with the best founders. We want those businesses to be super successful. But our number two value is heart. Like, how many investment firms have heart as their number two value? And the reason I bring that up is we always want to do things in the right way. And so even though there is ego, and you have to have an opinion, it doesn't mean you got to beat people over the head with it. And you want to be fair about it. And like, I think we ask our founders to be similar, and we ask our execs to be similar of like, we hired you or we invested in you because we think you're the best. We think you are the person to run this business. You're the person to get it there. But like, we'd also ask that, like, if something comes up that like you're willing to take direction, right? It's it's potentially trite, but it's like, my wife always jokes, she's like, we'll be in a foreign country. She's like, why don't we just ask for directions? Right. Yep. And I'm just like, I've learned over the years, I was like, I just need to ask for directions every now and then. Like, like we always use we use the Waze analogy. We say, our CEOs are in the driver's seat. ultimately they have their hands on the steering wheel. But if we can be ways and we can say, hey, like actually there's a crash up ahead and like maybe you should turn right. Like that's all we want to be. We want to help them get there, but ultimately like they got their hands on the wheel. They're the ones driving. Yep. But we have to take direction and not just like, driving the traffic.
I like that. Hey, so buyer-led, we talked about just your rigor around having this strategy, the strategic positioning, supporting a lot of these portcos with finding opportunities and just being proactive and not just waiting for stuff to show up on a deal book.
Yeah.
The M&A, I know most PE firms usually have a 90, 100-day plan sort of model.
Yeah.
How do you work with portfolio companies, right? We kind of go through the deal. We got something we're going to close. Like hopefully you're planning integration before you close.
Yeah.
Like, can you walk me through what that support looks like in your...
Yeah, totally. So we 100% think you should have an integration plan before you close. I hope that every company has an integration plan before they close.
How about an integration thesis at LOI?
I mean, you should, right? And it goes back to those categories of types of M&A you're doing, right? There are times I think that where 100-day plans go wrong, they feel like they are boil the ocean, very static documents. And they're like, I have to have this 100-day plan and like, we're going to tick through all the boxes and like, yes, there is a certain level of like, there are, you got to get people new badges. You got to get laptops, like, you got to move the systems. Like there are like really minutia things that like do have to get done so that everybody feels, especially on the acquired business, like you want employees to feel like they're being welcomed into this new environment and you want them to feel like, okay, there's a path forward. And like, if somebody's badge doesn't work on the first day, they start, everybody spirals, right? So you do have to have the checklist, but ultimately, like, I think the best 100-day plans are 1, flexible and regularly updated. And then 2, depending on the category, like they are tailored to what the situation is. If this is if you have a 100-day plan for a 5-person acqui-hire, that looks very different than, I'm doing a merger of equals of 2 direct competitors in the same geo. Like those are fundamentally different 100-day plans. And so you have to create those different plans and then you have to be willing to adapt. Like one of my favorite, I got a lot of favorite CEOs, but one of the ones I've learned the most from is one of our CEOs, Lisa Stinnett over at Inhabit IQ. She is like a machine on M&A. And ultimately, like if you look at her 100-day plans, every deal that she's done has a 100-day plan and it gets updated like every 30 days. And like the team is just methodical around like understanding where it is, updating, moving, and then like reassessing where it is. And they just have this cadence. And it's the right balance of focusing on what matters while still being flexible to keep it ongoing. And then, you talked about support. We'll be heavy on the strategy creation. We'll be heavy on the sourcing and the execution where needed. Sometimes our companies say, I got it. This is the 10th deal they've done. They have a full corp dev team and like, we're not dogmatic about being in their shorts about it. We're just here to be helpful. Again, it goes back to the alignment piece. Like we only care about the outcome. We don't care about we have to do something X way or Y way. But like we are always willing to be helpful on the execution and getting the funding and the transaction done. And like we do want to be helpful on getting the 100-day plan set up. What I learned relatively early in my career though is if we own the 100-day plan, it doesn't get done as well as if the company owns a 100-day plan. Meaning that somebody in the company has to be accountable to it. Somebody whether it's the CFO or the head of FP&A, like it should be, 70 to 100% of one person's job for the foreseeable future to get it done. Adam Berger, one of our operating partners, who has just been an amazing mentor to me over the years, he always says, if this M&A is not the most important thing on the strategic roadmap, you probably shouldn't be doing it. And he said, a lot of people kind of cheap out and they say, it'll be like 10% of the CFO's time, 20% of, the head of FP&A's time, maybe like 5% of all these other people's time. And he's like, no. You need one person who is going to update that plan, make sure all the functional leads are actually coordinating and updating their plan, running the weekly stand up to make sure like somebody has to own it. And if it's not important enough for you to make it 100% of somebody's job, you should probably not be doing the deal.
Yeah, it's a big bet.
Yeah.
It's interesting talking to different sizes of firms, and I'm almost like seeing a correlation between how much AUM a firm has and how much portfolio support they can provide. Yeah. Is that a real thing? And it's a different topic. We can debate this with me directly or not here, but the bigger funds will pay more. You don't have to answer
Hopefully
that.
not. But
yeah, I think it goes back to what we talked about earlier, like how much you belief you have in your strategy and what you're going to execute should determine what you're paying for it.
Totally.
But on the portfolio support, I mean, that's what I've noticed. If you're small fund, definitely like sub billion, sub 500 million, like it's not, you're really counting on some.
I think it's tough. I mean, for us, we've leaned into scale as a differentiator. And ultimately, we believe, I think there are two components that really matter at scale. It's access and expertise. Like everything's about access and expertise. Like how do we use our scale to get you better access? That's more access to other portfolio companies. Like we don't have all the answers internally, but I'm pretty sure that one of our 500 other companies has solved the problem you're trying to solve. And so it's like, we want access to other portfolio companies. I want access to buyers. We work our Inside Ignite team or our enterprise team, like they spend their lives looking for relationships in the Fortune 1000. They want to know the buyers of software in, C-level buyers within all of the Fortune 1000 companies. Like we want to provide access to that and use our scale and our portfolio scale to actually provide that access. And then on the expertise side, we want to use all of our data, right? So like there's AUM scale, but there's also like, we've invested in probably 800 companies over our lifespan, exited, hundreds of companies. We've seen companies go through every, within a vertical, like we probably have 12 data points of other companies that have gone through your journey. And we want to use the data as well as the expertise from people who have actually sat in your seat to give advice. And you can't do all that in $1 billion fund.
Right.
Like you literally can't pay for you use this phrase cost center. Like for us, like it's an investment and we think it has a super high ROI as we already talked about. But ultimately, like that's a lot of cost that we're bearing, and that benefits our portfolio, that benefits our LPs. Like we fundamentally put our money where our mouth is of believing that we can change the math, right? Like fundamentally, like why can strategics pay more than PE firms? It's because they can change the math. They just have a different math. Like they can plug in whatever acquisition into their existing behemoth of a business, and like the sales channel's already set up, and they already have a good R&D org. Like they're able to pay more and still have good deals because they have different math. Our goal is to do the same thing. Like how do we have different math using our scale? As we talked about over lunch, there's really only two ways to make money. I would say there used to be three ways in that you can always get you can just find things before other people. I think it's becoming harder and harder. We still do it. I would say, half our deals are still proprietary, or are not going through a bank process, or we've had a relationship. Like, the average time between first meeting a company and actually getting a deal done is like 3 years. That's the median. Wow. Like we're really getting to know people over a long time. But I think that is going away. I think even earlier stage companies are getting bankers involved and all of that to go through fundraise. So like really the only two advantages you have to make money in this industry is either taking more risk or having better changing the math, having better operational support. And we've said ideally you wouldn't take more risk. You should take educated risk. Like we're obviously in the business of taking risks, but like ultimately, like if we can also lean on better operational support, there's good ways of driving return simply using our expertise and our access at scale within this portfolio.
Yeah, that's a big part of it. I think it's one of the pillars when looking at what private equity firm to work with. It's the price they'll pay, the terms, and then the operational support that comes working together.
you also got to like them too, right? Like I
Fits in there too.
I mean, you think of raising capital, as somebody once said, raising capital is like getting married. Like, you're kind of stuck with us, we're stuck with you. And like, we both have to make it work. And, ultimately, again, it goes back to like why I think heart is a meaningful value is like, we always want to do the right thing. We want to be fair. It doesn't mean we're going to be soft, but it does mean that we're always going to be fair and be good partners to our portfolio companies. And ultimately, I think you want people around the table who are going to be both your biggest cheerleader, but also your biggest coach on pushing you a bit.
Make sure you have a good prenup.
Yeah. Those don't fully exist, right?
That goes back to the terms. Terms, like, hey. Yes. So you mentioned too at lunch, buyers are getting more sophisticated. Tell me more about that.
Buyers are definitely getting more sophisticated. Part of it's just the market that we're in, right? When I first started here in 2015, I had this amazing, we're still a small team, and there's this amazing rite of passage that our team would usually help our investor relations team put together all the materials for our annual meeting. And so, my first year here, I was a lucky one who drew the straw of like, putting together all the materials for this thing. But like, it got me more involved in our IR process, and ultimately, what it allowed me to do was like go to LP meetings and hear questions from LPs. And what was fascinating, and I'll get to your answer. Like, what was fascinating is in 2015. You talk to LPs and they were like, why are you guys doing software? Like, why are you all focused on software? Like, why should I as an LP invest in software? I got real estate, I got industrials, I got pharma, I got healthcare, like software only. Like, why does that need to even be a part of my portfolio? Then you fast forwarded to, 5 years, 2019, 2020. And then the question was, I totally get why I need software. Like, what makes you guys different, right? And I think that's like that level of competition has just like the realization of everybody wants to be in high tech. You look at the Magnificent Seven, all of that, like everybody knows that like a lot of the returns are going towards software and tech. And so it's not even a question anymore that people should be in it. And what that's created is a market where you get more entrants, right? Like I would say 2019 through 2021, 2022, like 2021, like you got a lot of people who started to do their first software deals. And then they realized after that, they're like, oh, maybe I should do more software. And so you've got a lot of entrants into the market. And what's created is people are now used to looking at software assets. And then they've also looked at more of them over time. So they've learned what to look for. And so I think software buyers are just becoming more and more sophisticated as in the market. And so, for us, what that means is you got to have really good product and you got to think about where your moat is. Like we want to, I think you will always, what we've seen through cycles is like the A+ businesses will always get A+ pricing. But I think, like in the heat of 2020 and 2021, I think you got a lot of B businesses getting A pricing still. And I think where the market has kind of corrected to, and I actually think we're in a good part of the market, is A+ businesses should get A+ prices, B businesses should get B prices, and C businesses should get C prices, right? And I think people are becoming more and more discerning as software as a market has grown and the entrance into investing in software has also grown.
It is. We're a lot more competitive. Yeah. It's getting a lot more competitive. I'd love to just kind of touch on just the themes, whether it is trends you're seeing around value add models that go beyond capital. We got AI everywhere. Everybody's slapping AI.
Yes. Everything. Yeah.
Sometimes using that as a reason to go increase valuation and stuff. And then you've just got all these startups popping over where they are raising on crazy valuations. What's your view? Teach me something there that I need to be thinking about as a founder of a business that is trying to keep up with some new AI features. And by the way,
no, we can definitely talk about AI trends. I mean, we're making a big push internally. We have this initiative called 5 and 5. Like we have this fundamental belief that all of our businesses should be able to get 5 points of growth and 5 points of margin out using AI. Like we fundamentally believe that we should be able to accelerate the growth, and that if you look at G&A, S&M, R&D, especially like there's a lot more places for efficiency using AI. I think R&D has been one of the biggest unlocks. If you look at where the most used use cases are using AI today, it is within engineering. And like what's amazing there is, I think if you reverse the clock back 5-6 years, most investors could tell you pretty well what to do and how to optimize S&M. They could probably tell you how to optimize finance and legal and HR and all that in G&A. And like R&D was this black box. They were like, oh, don't break the product. Yeah. And so they wouldn't touch it. And now you're just seeing more efficiency come out of those orgs, like better, like deployment and DevOps. Like there's a lot of tools using AI. And so I think that you'll see a lot of a bigger push there. I think in terms of product, for as I think about advice, like I do think the biggest, like what we talk to our companies about is you should get out ahead of your product and think about where the product mode is versus like an AI future, right? Like if you're living in that world, it's going to be a really tough few years for you because they are just releasing at a pace that is unprecedented. And so like we really push on like, how do I actually incorporate it? It doesn't mean you got to fully rewrite it, right? Like I think historically, like one of the most interesting things, hopefully for your listeners on this, with this business Optimizely, where we've been in the business for a few years now. Originally, we invested in a business called Episerver. We ended up merging with a business called Optimizely, and they do think of it as like web A/B testing.
Yeah, I was an early customer. So
yeah, so like they're an awesome business. Like marketers are famous for having too many tools. Like we fundamentally believe it's like you have your website, you need to figure out how to test it. They're using AI to figure out like what test do I run, how do I analyze it. But what was fascinating, they actually used, it's a good M&A story. They acquired this business called Welcome, kind of a digital asset business. And, the historic, as all this AI stuff happened, the CEO was actually super out in front. He's like, we have to be AI first. Like we want AI, like, but how are we going to do it? And they actually used the founder of that business they acquired, Welcome. Like he became like the AI guru across the business. And what they ended up doing, which was really cool, was they had really strong software. And instead of across multiple parts of the marketing stack, and instead of like taking the conventional wisdom of like, oh, I got to go rewrite all of these pieces of software, like, and be AI first, they actually said like, no, those software components actually work super, super well. And we're just going to create an orchestration layer over the top. And so, that founder and Alex, the CEO, were amazing in that they basically developed like a new like a co-pilot on top of their existing software. So they didn't need to rewrite, but they gave the fundamentally the user experience changed. And now like you as a user, you did all the orchestration using your AI co-pilot, and you didn't actually have to touch the underlying pieces of software at all, really.
Oh, interesting.
And so it's like they went against this conventional wisdom of you're going to have if you're old in legacy or like if your software is written more than 5 years ago, like you're going to be dead. And they're like, no way. Like our software is good. It actually creates a lot of value. We're just going to give you the right user interface to it. And we're going to allow you to orchestrate our software even better. And and
disrupt those users or
totally. And like, so they used and then they used all the data coming out. They have so much data underneath. So like it was an example of kind of an incumbent utilizing it versus being afraid of it. And I think that's ultimately where you gotta be. And hats off to Alex and that team for being ahead of the trend and being super thoughtful. And like, my sense is it's not one of mine, but my sense is from the team that like it's growing well, and growth is accelerating quite well, like off of the back of a lot of this AI orchestration and utilizing the new tools at your disposal.
It's a great example. You got to be taking bets on AI if you're a company in the field today.
Totally. I think it's, budgets are also fairly unlimited with AI. Like we'll see when the music stops. But like, I think what's interesting is, and this is maybe my hot take that people won't want to agree with, but like, I think you get a lot of articles talking about AI is fundamentally different business model. You can't underwrite it the same as software, all of that stuff. I do think some of that's true. I do think the pace is moving quicker. I do think the adoption has been amazing. You maybe don't need the same amount of tooling or people that you need, but fundamentally a business is a business. It's I create product, I have to have a channel to sell that product. Somebody has to buy that product and use it well, and then they have to renew their contract. Like, and they pay like the fundamentals of business and like what you're looking for of like, am I bringing in more customers? Are they staying with me? Am I keeping them happy? Are they paying me more over time? Those haven't fundamentally changed. The reason that the metrics look so funky is I haven't been through as many cycles as some of our most senior partners, but like it's the first time, at least in my career, where you've seen just supply and demand like completely meet. I think before you look at the SaaS conversion, I spent the first 5 years looking at companies and really thinking about like, oh, enterprises are slowly moving from on-prem to SaaS. They should have all moved, but like they're just slowly moving. Yeah. Versus it's the first time where I think every single company across the world was like, oh shoot, like I need to go invest in AI. And so they released budget at the same time where the capabilities were there. And so that's why these growth curves look like vertical, right? Because you just had this really good supply demand meeting moment. In reality, I think over time, like people will think about where the budgets are, and I do think it'll look more fundamental. But I think we're at this super interesting time right now where the supply of dollars and the demand the supply of technology and the demand dollars are like fundamentally overlapped. And I think you'll see that for a few years here. And then like fundamentally at the end of the day, I think the fundamentals will still be okay and it will still be similar long term.
We'll see if valuations come down.
I don't know. I would say it's unprecedented. You're seeing some of these rounds happening, and
the growth is there.
The growth is there.
What's the craziest thing you've seen in M&A?
M&A ultimately comes down to the people. I've seen founder to founder shouting matches. I've seen deals blow up 3 or 4 times before actually getting done. I think fundamentally, like everything in life, like it looks, spreadsheets, yes, they work well together, but fundamentally you got to get people working with other people to drive the business forward. And so I think, ultimately emotions always play a factor, and logic always has to, somewhat overcome it. But it's I mean, even software business, yes, there's a lot of workflow, but like most of the costs are people, and like we are in a people business.
People are both predictable and unpredictable.
100%. And oftentimes M&A can feel very existential, right? And both for founders, shareholders, and also employees, right? And I think that there's a lot of emotion in selling your baby, or there's a lot of emotion in getting acquired. And so I think, like, as somebody who's worked with businesses to acquire a lot of companies, we always lead with this idea of like, you got to be open and transparent and thoughtful. And like the goal is like, be good humans, like make sure that people feel stable, give them the right vision, don't hide the hard decisions. I listened to one of your podcasts that you just did. And one of the takeaways I think was with the Alpine Invest folks. And, one of the best pieces of advice was like, have the hard conversations early, get it all out there, and like get aligned early. I think that's totally right.
This has been an awesome conversation. Thank you for taking the time, helping me become a better M&A scientist here.
This is amazing. Thank you so much, Keystone. Really appreciate it.
And those of you listening all the way to the end, fellow M&A scientists, I appreciate you tuning in, listening through. I love hearing from you. I'm most reachable on LinkedIn. Connect with me. Give me some feedback, the good and the bad. Like the criticism. That's how I learned to get better at this. If you got some interesting topic ideas I haven't picked on, till next time, here's to the deal.